Today, it may be hard to believe, but there was a time when Enron was considered one of the most brilliant companies in America. At its peak, it became the seventh largest corporation in the United States. The company promised to revolutionize the energy market and transform the way electricity and gas were traded. Investors, politicians, and analysts believed they were witnessing the future of corporate innovation. But there was a problem. Behind the image of innovation, there was something far darker: lies, fraud, financial manipulation. This is the story of how a company took 10 years to reach a valuation of $60 billion and less than a month to collapse into bankruptcy. This is the story of Enron. Enron began as a natural gas pipeline company. Its founder, Kenneth, grew up in a poor household. His father was a Baptist minister, and Lay believed success was his path out of poverty. With a PhD in economics and strong political connections in Washington, Lay became a key advocate for energy market deregulation in the United States. This created a massive opportunity. Instead of simply selling energy, Enron could trade energy like a financial asset. Energy would become something bought and sold just like stocks. During the 1990s, Enron reinvented itself. Under the leadership of Jeffrey Skilling, the company began trading energy contracts like financial securities, natural gas, electricity, broadband bandwidth, and even the weather. Yes, Enron created financial contracts that allowed investors to bet on temperature and rainfall. To Wall Street, this looked like pure innovation. The company's stock price soared year after year. Enron became Wall Street's darling. But there was one problem. Much of the profit was not real. Jeffrey Skilling introduced a system known as mark-to-market accounting. This allowed Enron to record future profits immediately. If the company signed a contract worth $50 million over the next 10 years, it could record the entire $50 million instantly in its financial statements, even if the money had not yet been earned. This created the illusion of endless growth. And when projects failed, the losses were hidden in off-balance sheet entities created by the company's CFO, Andrew Fastow. On paper, Enron looked incredibly profitable. In reality, the company was hiding billions of dollars in debt. Inside the company, the culture was ruthless. Employees were ranked constantly. Every year, the lowest 10% were fired. The message was simple: make money or leave. Executives worked extreme hours. Competition inside the company was intense. Risk was celebrated. Greed was rewarded. And as massive bonuses were handed out, very few people stopped to question whether the numbers actually made sense. In the late 1990s, Enron discovered a new opportunity. California had deregulated its electricity market. Enron traders quickly realized they could manipulate the system. They moved electricity out of the state, creating artificial shortages. Then they sold it back at much higher prices. The result was catastrophic. California experienced rolling blackouts across the state. While millions of people struggled without power, Enron traders celebrated their bonuses. The crisis ended up costing California $30 billion. Despite Enron's apparent success, a few people began asking questions. A journalist from Fortune magazine, Bethany McLean, started investigating the company. Her main question was simple: how exactly does Enron make its money? Surprisingly, no one could clearly explain it, not even the executives. Soon after, the U.S. Securities and Exchange Commission launched an investigation, and the truth began to surface. Hidden debt, shell companies, massive accounting fraud. In 2001, everything began to unravel. Investors panicked, the stock price collapsed. Within weeks, the company that once seemed unstoppable filed for bankruptcy. It became one of the largest corporate failures in American history. The fallout was devastating. More than 20,000 employees lost their jobs. Many had invested their life savings in Enron stock. When the company collapsed, they lost everything. Meanwhile, executives had sold hundreds of millions of dollars worth of shares before the crash. Jeffrey Skilling was convicted and sentenced to 24 years in prison. Andrew Fastow received 10 years after cooperating with prosecutors. Kenneth was convicted of fraud, but died before he could be sentenced. The Enron scandal revealed something profound about corporate America. For years, analysts, banks, and investors preferred to believe the story instead of questioning the numbers. Ironically, Enron's motto was, "Ask why." But during its meteoric rise, almost no one did. And perhaps that is the real lesson of the Enron story. When a company seems too complex to understand, that may be exactly the moment we should start asking, why? Leave a like, subscribe, and share.